We're going to talk about chapter 5 today and Wednesday. Maybe we'll do some more next Monday, next Wednesday. Next Monday, we don't have class, it's Labor Day. Uh, let's first, let me get a little bit better exchange rate data. I have this page from investing.com. Let me copy, insert, not insert, data, get data from other sources, from web. Not all the exchange rates are here, but most of them are. Most major ones are. Come on. My problem with EKU stuff. I'm gonna get this table. Load 2. Table. Okay. I'll keep all of them here. Let's do table design. No, actually, query properties. Enable every 1 minute. Refresh when it's opening the file. Fast load. Okay. Now, first thing that you gotta notice, it doesn't actually give me a single exchange rate. I mean, I have the daily low, daily high, change from yesterday and stuff. But the first two columns are bid and ask rates. Okay. There is no organized exchange rate market. But even with stocks and stuff, if you simply say a market order, a market buy is going to get you the ask price, and market sell is going to get you the bid price. So if I'm buying US dollars against euro, which one of the prices are relevant for me? Remember, the convention is price of the first currency in terms of the second. So if I'm buying US dollars, what am I selling? Euro. So if I'm selling the euros, then should I think about the bid or ask? Bid, because it's what people are willing to pay for euros against US dollars. So if I'm selling US dollars, I'm buying euros, then I'm going to look at the ask price. This is pretty much the spot market. Oops. I mean, technically speaking, this is actual transaction happens at t plus 2. So if we agree on a transaction today in the interbank market, we agree on buying the euros and or getting the euros and delivering the dollars 2 business days from today. That's what spot market is. Just like the stock market. When you do the actual transaction, you buy stocks, the cash actually gets out of your account 2 business days, 2 trading days after. Uh, I mean, a lot of brokers allows you to take it out early and stuff, but the actual transaction clears at T plus 2. And for each pair, especially pairs uh, including US dollar, we have a bid and ask or offer prices. And convention is currency 1, currency 2, which means price of currency 1 in terms of currency 2. So if I say USD JPY, in this case 147.55.56, so that means if I'm buying US dollars, I'm going to have to pay the ask price. And I said only 56 because the first three are understood to be the big figure. And typically it varies from currency to currency, but you have 4 significant digits. In this case, 47 and 55 would be the 4 significant digits. But in other currencies, for example, this is price of 1 US dollar in Japanese yen. Euro USD is 116.47.49. For major currency pairs, typically those bid offer spreads are pretty tight. In fact, we call there's a name for the last digit, it's called a tick. So if I go from 147.55 to 56, you move by 1 tick. Sometimes people call it tip as well. This is value or price of €1 in US dollar terms. Obviously, bid is always less than the ask price. So let's take this. If I ask you, give me the bid offer spreads in terms of USD euro, value of $1 in euro terms, what would you do? there is no bid offer spread. The exchange rate is simply the reciprocal, right? So for the bid, which one I'm going to use? Uh, 47 or 49? One over. What do you think? The bid for US dollar is actually should be calculated using the ask for euro. Okay? Because if the ask for euro means what are you willing to pay or what am I willing to sell 1 euro in US dollars. But if I'm uh, buying the US dollars, it has to be calculated using 116.49 versus let me calculate them using my trusty phone calculator. Since we have a 1 over x button, so that's 0.8584. Okay. I mean, normally you would round it up to 4 digits, but I just leave it there. Or I could write this approximately as I round it down on the bid and round it up on the offer.